into the market, your product would be created or not, that risk is also there. Here, at least in case of venture capitalists, that risk is not there. So they have a fair chance of taking it off. So this was all about venture capital fund and angel network. Now I will move to some other options also of the funding. Another option is the private equity. Private equity are the investment that are made in those firms which are not publicly listed on any stock exchange. Means the private equity is normally given to the companies which are not yet publicly listed. There are exceptions to this, but most of the time this happens. Unlike the angel investment or venture capital, PE fund is always given to the matured companies. They are having good track record. So here the investment is quite safe. Private equity firm, the idea of the private equity firm is to acquire the company, grow it, sell it off. So they look for 100% of majority equity and invest it. This fund is normally utilized for the financing or operational restructuring of the investing company so that they can sell it in the market over a period of time on a very good valuation. So this is the way the private equity funding is done. Private equity fund, these are the again like the venture capital organizations. There are many private equity organizations who deploy the large sum. The ticket size is normally 100 to say 1,000 crore kind of thing. They deploy in any company. Let's understand what is the difference between private equity and venture capital. Venture capital fund is given at the seed stage or at the beginning of the growth stage. But private equity is always given to the matured company or their growth, further growth I would say. What investors look at? In case of venture capital, the venture capitalists look at the idea and high growth. Here, you don't have any track record, you don't have any big sales, you don't have any security to back up. But yes, you have the good idea, you have a high growth potential. At this stage, the venture capitalists come into the picture. Whereas, the private equity firm, they evaluate the probability that if you have good probability, then only they will come into the picture. They will look at what is the past 3 years record or past 5 years record. If there is stability and continuity in the profitability and growth, then only they will come, otherwise they will not come. Whereas the venture capitalist doesn't look at all this because they are not having this available track record. Just as I told you earlier, but private equity is a bigger fund, as I told you, around 100 crore to 1,000 crore, $10 million and above. Venture capitalists look at the top line first. Because he is not having a capacity to look at the bottom line. Since still the product has not taken off in the market. So his target is how to increase the top line, means how to increase the sales. Whereas private equity owners look at the bottom line, means the profitability. If profit is there, then only they will come, otherwise they will not come. He doesn't look at he doesn't target the profitability. He look at the valuation of the company should increase, and once valuation is high, he will get out of the company. He will exit. He will sell his stake. Whereas private equity partners normally they look at the perpetual profit, means continuous profit. Another refined version of venture capital fund is the venture debt fund. This has come into the picture after realizing and experiencing that the venture capital fund, private equity fund, they all are very expensive source of the funding because you have to always dilute the equity. If you don't want to dilute the equity, then what to do? Then this option comes into the picture. Normally, NBFCs offer a hybrid system called venture debt fund, which provide debt financing to the VC backed startups. Means they provide the debt financing only to the organizations which are already supported by the venture capitalist. At this stage, why to go to the venture debt fund? Because you don't have the security, you don't have still a track record to go to the bank for the loan or the equity. Because at the expansion stage or the growth stage, you need working capital, you need the long-term capital or funding of your startup. So at this stage, money is required, but you don't have the security, you don't want to dilute the stake, then this option is very good option of the venture debt fund. Venture debt fund gives the money in return for the non-convertible debentures. Non-convertible debentures basically earn the interest. So you have to repay them the interest every month or every quarter or every year, whatever the term agreed. Here in return you have to give them the interest. Arteria Capital and Trafficta Capital are some of the players who provide the venture debt. There are many more. At the initial stage, you have the option of the government grants also. But this is available only at the initial stage, not at the growth stage. In 2016, the government of India had launched the Startup India program. The government disburses the fund as long as you are working, you are registered with the Startup India under the Startup India scheme, and this grant or fund is provided to the city under the fund of fund scheme. The program offers grants like 80% rebate of patent cost when you file a patent, then it costs. So 80% rebate you get, some income tax exemption you get for the first 3 years of the registration of the startup. All those things are there which are available by the grant. You can imagine that the last year the government launched another Startup India Seed Fund scheme, which provides funding to support the early stage startup. Under this scheme, government has allocated 1,000 crore under the funds of fund scheme, and 280 crore for the Startup India Seed Fund scheme. So these are the government schemes which are available for the startups. Again, at the initial level, absolutely initial level, accelerator and incubators also come into the picture. Because whatever we have discussed, these all funding options are available either at the initial stage or the growth stage. But at absolutely beginning, you just have the concept in your mind. These accelerators and incubators come into the picture and they help you out. Basically, these accelerators and incubators are the preparatory school for you, for the startup. These incubators run a program for 6 months to 3 years, where they provide you the place to sit, they give the idea, they provide you, they connect with you the mentors without any cost, they connect with you the investors, and they help you to set up your startup. Accelerators and incubators generally take equity stake in return of your program. Means when they allow you to sit with you, they give you the place to work, they connect you with the investor, mentor, etc. They provide you some legal help also. So they also take some stake in yours. Some of the popular accelerator programs for Indian startups include Y Combinator, you must have heard, GSF Accelerator, Microsoft Accelerator, Google Launchpad Accelerator, Jain, amongst all many more. So these are all available options. Another option widely available today. This also comes somewhere in between the venture capital fund and PE fund. The very widely emerging option is there. There are all business houses these days have set up their family offices where they manage the family wealth. And in this process, they invest their money in good startups where they feel that this will grow. You might have heard that Ratan Tata ji used to invest in lots of startups. Mukesh Ambani ji also invested in the startups. So this is all through their family offices. Rajiv Jain ji regularly invest in the startups, again through their family offices. So you must have heard. So this is also becoming very popular and becoming a trend. In India currently more than 140 family offices are working. The family houses are basically more patient than an investor. They give a startup more time, more money, more resources, more breathing time to grow their business. Because they have seen their business, they are already a businessman. So they understand the intricacies of the business. A report by Access Global predicts that Indian family offices are expected to contribute 30% of the estimated 100 million to be raised by the Indian startup by 2025, means by this year end. At least they will invest $30 billion. Adani, Bharti, Capier, ATG, Hero Honda, Havels, these are all family offices. Wipro. So almost everybody has set up the family offices through which they invest the money in the startup instead of investing their money in some stereotype options. At early stage again, the crowdfunding is also another option. This is very crude option which is not legalized or is still a regulated option. It is basically a small group of the investors, they come together, come on the platform and invest in the startup of their choice. They are basically not registered. So it is like an angel network, but not that formalized and registered. Every investor invests a fixed amount in business idea with the hope of getting the hand. Crowdfunding is always prone to controversies and scams because TV has not regulated and doesn't regulate these type of things, and they are all unregistered platforms. So one has to be very, very cautious about it. Now the last comes at the growth stage, debt from banks and financial institutions, which is more structured, most demanding in terms of the paper, track record and other things. This is very, very conventional funding option. Bank loan, which is most cheapest always. Bank always offers different type of loans for different business requirements like equipment loan, startup business loan, working capital loan, each with different set of terms and conditions and cost. And idea is still also theoretically bank fund to the startup, but practically it is not possible because they don't have any track record of the past. They don't have the collateral security to give. So normally it is not workable. It is only on the paper. They also want that you should have some other source of income also to repay the debt by the time you start earning from your startup. So all these things are not workable. And this is only a theoretical option. What is debt financing? Let's understand. It is basically a loan. It can be taken from bank or financial institution, non-banking financial institution. This is the cheapest mode, but difficult to get it because bank and financial institution look at the past track record, proven past track record in fact, and collateral securities. Now the last is the revenue-based financing. Revenue-based financing allows the startup to get its future revenue upfront. Means whatever you are going to earn in next 2 years, 3 years time, you suppose you get 70% of that right now. So easily you have the money, you can invest it towards the inventory, advertising, marketing, growth, etc., etc. The repayment of this is also very easy because you again start repaying it over a period of time against your revenue. Whatever you earn, a part of that it goes to repays. Some of the revenue-based financing companies for Indian startup are basically Indian startup include Velocity, Club, Get Vantage, among others. So these are the companies who do the revenue-based financing. This is all about startup funding today. Now I am open for the questions.
Ask any questions. Anyone has any questions?
Yes, please.
Yes, sir.
Yes, sir. Yes.
I have another question.
very strong. You don't have the track record of the big sales, big audience or big market group or big customer base. So the idea or the concept should be so strong that it can cover this weakness of not having the track record or the security available for the funding. So you should have very strong idea, very much, there is no much competition in the market, it is a niche product, new product. So idea should be very strong, that's the only thing. If you have some, if you come today, come out as a competitor for Amazon, nobody will go to your site. Because you cannot match the Amazon. So you have to come with such idea which is not available in the market. There is no point to competing with the Amazon or Flipkart today by human like people like you and me. Can you remember?
Any other have any questions? That's it. Anuja, Arti, newcomers. No question? Huh? Rohan? No question, ma'am. Yes, sir, there is no question. Now we will conclude the session. I will thank you, sir. I extend my greatest vote of thanks towards you, sir, from the MBA department and also Space College of Engineering, Pandharpur, Autonomous Institute. And not but the least, Dr. P.P. Rungi, sir, who has given us opportunity to conduct such sessions more and more to enlighten the students, and they start their own enterprises or the startups they can have. Thank you, sir, and thank you all the participants.